Welcome to my channel. I'm Scott, and I'm going to walk you through the process of valuing Kirkland Lake Gold stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Kirkland Lake Gold is a Canadian gold mining company that owns and operates several gold mines in Canada and Australia. The company's headquarters are in Toronto, Ontario, Canada, and was founded in 1988. They started trading on the New York Stock Exchange in 2016 and the TSX in 1996. Originally, it was named Goldpack Investments, then Brimstone Gold Corp, then Fox Point Resource, and finally Kirkland Lake Gold. It acquired St. Andrew Goldfields 3 gold mines that are about 100 kilometers from Kirkland Lake in an all-stock deal worth $178 million. The company also acquired Vancouver-based Newmarket Gold for $1 billion in stock, which owned gold mines in Australia. It also acquired Detour Gold for $4.9 billion. Let's get started with the model. This is a mid-cap company, $8.8 billion market cap. They're trading at $33 a share, and they have 267 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has positive and growing free cash flow each year. They're doing a great job growing their business through acquisitions. Net income is a profit and loss on the income statement. That's revenue minus expenses. That also grows a lot from $130 million to $720 million. Revenue is the sales for the company, and that triples from 2017 to the trailing 12 months. It's up to $2.2 billion. They also have really good profit margins. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. And they converted 33% of their revenue into profit in the trailing 12 months, which means 67% went towards expenses. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The difference between those two numbers is their gross profit, and that was $1.3 billion in the trailing 12 months. It has been growing a lot each year. Below that is operating expenses, then below that is operating income. That's gone up more than 5 times since 2017. Below that is the interest they receive on their investments minus the interest they pay in their debt. So they actually have interest income coming in since they have so little debt. Below that is other income and expenses. This is usually impairments or other non-operational gains and losses. Below that is pre-tax income, then their taxes. And the bottom line of the income statement is their net income. And the company has positive and growing net income each year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And this company has a lot of free cash flow to work with. They've been paying down debt each year. They've also been buying back stock every single year. They bought back $500 million of stock in the trailing 12 months. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. The most important part of any business is their operating cash flow. And this company generates lots of operating cash flow. You could think of operating cash flow as net income converted to cash. Net income is your accounting profit and loss. It's not actual cash. And to calculate operating cash flow, you start with net income. Then you have to add or subtract the non-cash items on the income statement. They pass through a $315 million depreciation expense onto the income statement. That brings down their net income, but it's a non-cash item. They also had $300 million of deferred taxes, $88 million of other non-cash items. Even though they reported $700 million of profit, they actually generated over $1.1 billion of cash flow. Let's look at the capital structure. $4.9 billion of equity, $26 million of debt. They're 99% equity, 1% debt. And their WACC is 7.4%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $17 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $15 billion. We divide that by 267 million shares. And we get a calculated stock price of $57. They're trading at $33, so they're trading at a 43% discount. It's a really strong buy according to the model. Simply Wall Street is a little lower than me. They're at $46, but they're also saying the stock is undervalued. This is the stock price the last 5 years. It looks like it peaked at about $50, but it's come down a little bit since the peak. This company has been raising their dividend a lot, from 1 cent all the way up to 19 cents. They pay a 2.3% dividend yield. They pay out 28% of their net income and 32% of their free cash flow. They have a really low beta, 0.66, so the stock moves less than the market. It's not volatile. The stock has only gone up 1.3% in the past 52 weeks, while the S&P 500 went up 17%. The 52-week low was 18, the high was 58. The stock is trading below its 50-day and 200-day moving average, so it seems to be on a downtrend. About 2 million shares are traded each day on this stock. 76% are held by institutions, and 1% of the shares are shorted. If you invested $10,000 into this company when it IPO'd in 2016, you'd be at almost $62,000 today. That's a really good return on investment. That's an average annual return of 54%. Van Eck is the biggest shareholder at 8%, then T. Rowe Price, Resolute Funds, Vanguard, and RBC. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a 12.1 PE, so investors are paying $12 for $1 of earnings. Price to sales is stock price over sales per share. They're at 4.0. That's between the median and average. Price to book is stock price over book value per share. They're at 1.8. That's better than the median and average. Interest coverage ratio is EBIT over interest expense. They have very little debt, so they can easily cover their interest payments. ROE is net income over equity. They have a 15% ROE. That's really good. Current ratio is current assets over current liabilities. They can cover their current liabilities 2.2 times. And their current assets are mostly cash at $850 million and $150 million of inventory. The company seems to be well capitalized. They had over $600 million of free cash flow, nearly $600 million of working capital, and a $200 million dividend payment. They have about $1 billion of funding. The best way to look at ratios is to compare them to similar companies. I've done videos of 10 companies in the gold industry, and if Kirkland has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're better in all the price multiples. They do have a good current ratio. It is a little lower than average. They have a really good ROE, much better than average. They have the lowest amount of debt of anybody on this list. And their market cap is lower than average at $9 billion, average is $15 billion. And they do pay a good dividend, 2.3%, one of the highest on this list. So to summarize, I have them trading at a 43% discount. This company is doing a really good job at growing their business, mainly through acquisitions. If they keep growing at this pace, they could be a $100 billion company one day. I ranked their free cash flows 9 out of 10. It more than tripled from 2017. I ranked their revenue 8 out of 10. It nearly tripled from 2017. And I ranked their ratios 9 out of 10. They have solid ratios. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.